Hello, and welcome to our second quarter 2017 strategy review. We met in this room on the 28th of March. In attendance was Dean Amundsen. Dean has met with us before, and he manages a very large bond portfolio. And bonds, again, were a very active consideration at the meeting, so we appreciated his attendance. Otherwise, on my right, Len Skena, CEO of the firm and Vice President, and on my left, Bob Toomey, Vice President and Director of Research. The meeting itself revolved a lot around what happens to bonds and, of course, generally the current politics, which when we met a quarter ago, we found that no one really had a good idea of what the new administration would be doing, and we needed to make decisions based on what we thought the effects would be. As it turns out, the overall effects on the market were really quite good, but when we got towards the end of the quarter, we saw the defeat of the health care bill, and there was once again questions about what would happen to the economic agenda as we go forward. These were all topics that we discussed and areas that we considered, and I'm going to now turn it over to Bob to talk about the current economic and market.
Thanks a lot, Stan. So, as Stan mentioned, clearly a very important topic of our discussion, as it always is in these meetings, is the economy. And because the economy and corporate earnings have such a major impact on the stock market. I would say in general, economic indicators continue to be positive and are improving. We look at small business sentiment in particular, consumer sentiment, indicators of industrial production and capital spending, all seem to be moving upward after several quarters, particularly capital spending and several quarters being on the weak side. The other thing I would want to point out is we are seeing a global synchronized economic recovery. That really means that for the first time in this recovery since 2009, we're seeing Europe, the United States, emerging markets, and even China starting to show some positive economic momentum. And that, I think, speaks very well towards the longevity of this economic recovery, and we think it can sustain for a considerably longer period of time. U.S. GDP forecasts are trending upward. I'd say that generally economists remain in this 2 to 2.5% GDP growth forecasting, but we're seeing some of that sort of tilting upwards towards the end of this year and into next year. Corporate profit growth is also improving significantly. That has, after several quarters of downtrending, it's now up, and I would say a very strong uptrend. With respect to the Fed, as you know, the Fed has a very significant impact on the overall interest rate environment and the economy. We think the Fed most likely will raise rates about three times this year, which they have said they would. Again, we think they'll remain gradual. We think that a lot of what they do will remain data dependent, as they have been saying for years. And when you think about what the Fed's going to do, really, they're in the same boat with the rest of us. They really don't have the greatest crystal ball of forecasting the economy. So it remains to be seen. We think they will continue to be gradual. As Stan mentioned, the new administration, if they can be successful with their tax and infrastructure policies, that should also be positive for corporate earnings and positive for the stock market. So in general, I'd say the fundamentals continue to be positive and supportive for U.S. equities. I'd like to now turn it over to Len for some discussion of our international outlook.
Thank you, Bob. Economies around the globe continue to recover from some lackluster years. However, in many cases, those recoveries are far from robust. We looked at a number of areas. Europe in particular is one that we have been focused on for a while. We continue to favor Europe while we overall want to underweight international. Europe has some issues going on. There are isolationist policies that threaten existing and future trade agreements. The valuations in Europe, while they're attractive, are in an area where the recovery is happening, but it is still very, very slow. And we would like to see a little bit more out of Europe before we go whole hog into there and say that this is absolutely the place we want to be. We've looked at a number of other areas. We discussed China. China is an area that continues to have great lack of transparency and a potential banking crisis, but they seem to be in some kind of a recovery mode as well. We decided after a fair amount of discussion that we did not really feel that emerging markets or China were an area we really wanted to go in at this time. So overall, our allocation is to underweight international, but overweight Europe within the international arena. And with that, I'd like to turn it over to Stan to talk about REITs.
Thanks, Len. REITs, of course, are an area that is a good piece of our portfolio, one that we've held for a long period of time. However, the discussion about REITs this quarter, again, centered around how they would react within the fixed income environment, because they do tend to be interest sensitive. Consequently, while REITs still look like a very favorable industry, they probably, as we saw, would not fare as well because of the interest rate environment. So we left our exposure pretty much the same. And I think that's a good segue into fixed income. Len?
Thank you, Stan. As Stan indicated, we discussed fixed income quite a bit in this meeting. And in the end, we went round and round and came back to very much where we were already with our allocation. We do see a situation where interest rates will likely be going up during the course of the year. The Fed has already raised them just in the last couple of weeks, and there are indications that they would like to raise them further. While we are seeing them raising these rates, we're positioning ourselves to try to lower the duration of our overall bond portfolio, because the further out you go on that duration, the more interest rate sensitive bonds become. And to protect you, we are trying to minimize our allocation on the long end while increasing our allocation on the short end. That said, typically you get lower yields on the short end, and so we have introduced some high yield bonds on the short end side to try to get some additional yield into the portfolio during a period when interest rates remain low, and while interest rates are rising, we'll be in a position, if we're allocating things on the short end, to be able to continue to take advantage of those rising rates as they occur. With that, I'd like to turn it back over to Bob for some discussion about changes in our model.
Thanks a lot, Len. So that was a great overview of our changes in our fixed income area. I just want to focus on equities really briefly. There were no changes in the individual ETFs that we use and are investing you in, which actually is a good thing. I think that overall the picture is one of relative stability, despite a lot of the news that you might be seeing on TV or the radio. I'd say that our equity weightings overall following this meeting were up slightly. We remain overweight U.S. equities relative to a normal allocation, and as Len mentioned, slightly underweight in the international sector relative to a normal allocation. We are favoring value over growth at this point. We have been doing that now for a couple of quarters, and the reason for that is because we think that value stocks tend to generally be larger companies that pay dividends and have higher free cash flow. And I think in a rising rate environment, these types of stocks will fare relatively better because they are viewed as more financially independent, if you will. They don't have to rely on the capital markets or the banks to fund their operations, and therefore that would help to sustain their profitability. In terms of our sectoral emphasis, we continue to maintain our holding in the biotech sector. We added that a couple of quarters ago. The reason for that is because we see it as a strong growth area, and that sector has been we still view it as very undervalued. So again, it's a value plus growth opportunity, if you will, in that sector. And in the developing equity area, we have maintained our position in the home builders. We think home building will continue to be one of the fastest growing sectors of the U.S. economy. The housing sector has been underbuilt of this entire economic recovery. And as I'm sure you're well aware in reading the papers and listening to the news, that there really is in certain areas a housing crisis, if you will, in terms of availability of homes for people that want to buy those in affordable homes. So we think that the home builders will continue to benefit from this trend. I'd now like to turn it over to Stan for a wrap-up.
Thanks, Bob. As you can tell from, I think, all the comments that were made, we were pretty satisfied, and actually we were satisfied with how the portfolios performed during the first quarter, and really felt that a lot of the same situations existed. So consequently, you will not see any really major changes in the portfolio. But again, we feel it's pretty well positioned to both take advantage of the current potential economic benefits and protect us against some of the wild volatility with our more conservative accounts. So with that, I'd like to thank all of you for tuning in again this quarter. Remind you that all of our previous quarters are on our website. So if you'd like to go back and see what we said last quarter compared to this quarter, it's an interesting exercise. I do it every once in a while. And with that, I'd like to say goodbye, and we'll see you next quarter.